Trading is the most popular form of investing. You constantly see traders with Lamborghinis, expensive watches, mansions. Trading often promises insane returns, far above what you can earn by investing the traditional way over the long term. Plus, trading seems like a very technical and rigorous thing, almost like a method that, if you know it, guarantees success, but easy enough for anyone to learn if they set their mind to it. What's more, there have even been so-called AI trading courses popping up recently, where it seems you don't even need to learn anything to become a millionaire. To trade, you don't need to analyze businesses, their competition, or the macroeconomic environment, two things that take a tremendous amount of time. You just have to look at price charts, the typical Japanese candlesticks, buy at a certain moment, and then sell. It sounds like magic. But hey, it's true that there are big funds, like Jim Simons's, that use maths to make money, and those people don't waste time studying whether a company has defensive barriers against the competition, or if it's going to run out of customers in 10 years due to the demographic pyramid. However, we want to make one thing very clear from the start. No, trading isn't a serious endeavor, nor does it have anything to do with the funds that use maths to manage assets. Of course, there are always a few lucky ones who hit the jackpot, but most people won't be so fortunate. Now, in a reasonable scenario, if you start trading, you'll likely just lose your savings. But in the worst case scenario, trading turns into a kind of casino where a lot of people end up in debt for life. So, today on Visualeconomik, we'll explain in great detail why trading doesn't work, why it has nothing to do with the mathematics used by the giants of the financial world, and why you should be very, very careful with these so-called gurus who keep popping up online. Are you ready? Let's get started. But first, if you're interested in the world of investing, not trading. If you want to learn how to manage your savings, protect yourself against inflation, and figure out how to make money beyond your day job, I've got some good news for you. At Visual Factory, we've created the Visual Factory Club, a newsletter where every week we send out free content focused on essential financial education, the ABC of what everyone should know to understand the stock market, financial markets in general, investment platforms, how to assess investment opportunities, and which markets may have more or less potential. Because of course, if you want to invest your money so you're not at the mercy of your country's economic instability, you at least need to understand the basics of the financial world. In the Visual Factory Club, you'll learn all of this completely free of charge through the link below and this QR code. You can sign up for the club and start receiving the upcoming editions. What's more, when you sign up, you'll receive a dossier where I explain, in a clear and simple way, the most essential investment concepts, what multiples or the PE ratio are, what indices are, ETFs, derivatives, funds, EPS. You get the idea. After that, every week you'll receive additional materials and market analysis to help you stay informed about what's going on. And by the way, the sooner you sign up, the better, since we send each episode of the series by email, and every edition is unique. If you're not subscribed, you might miss some of them, and you won't be able to access them later. But with that said, let's get into the video. In 1827, botanist Robert Brown used a microscope to study the movement of pollen in water. Each particle moved in a completely random manner. One moment, it would go up, and the next, it would turn to the right. But it didn't follow any kind of pattern. And yes, I know, it doesn't sound very interesting, but that day, Brown changed the world forever. And what interests us most right now is that he changed the world of finance. Today, this type of completely random movement is known as Brownian motion, a concept that is absolutely fundamental in mathematics, and which, interestingly, can also be applied to the stock market, as if stocks were pollen grains moving up and down randomly. Of course, that's not the whole story. In the long run, stocks do well if the company does well, and that's not random. But there is a part of the price, particularly what happens with short-term stock price volatility, that follows these mathematical rules of Brown. That's why the first person to apply them correctly became the richest mathematician in history. We are, of course, talking about James Simons, the founder of Medallion Fund, a fund that used mathematics and Brownian motion to make a fortune. If you had invested $1,000 in his fund in 1988, you'd have over $7.5 million today. That's an annual return of 40%. even though the fund's fees are a whopping 40%. Excluding fees, the fund has achieved annualized returns of 65%. In other words, that's the equivalent of doubling your capital every year and a half. By comparison, the S&P 500 has a historical average of around 10%, but Warren Buffett became the most famous investor in history by achieving returns of between 15 and 20%. Put another way, the Simons Group more than tripled the returns of the most renowned value investor in history. Yet at Medallion, Simons' fund, there are no economists or Wall Street analysts. It's a group made up of physicists and mathematicians. So yes, maths can be used to make money in the stock market. No one denies that. Even within charts, patterns can be recognized and predicted. Now, Medallion is a private fund open only to its employees, and both it and its competitors employ some of the world's best physicists and mathematicians under confidentiality agreements stricter than those of Kremlin spies. So why do they keep paying these huge salaries? Well, because Simons didn't come up with a magic formula. He didn't create the definitive algorithm that cracked the stock market for good. And of course, he didn't come up with a couple of simple rules to tell whether the market is going up or down just by looking at a chart. What Simons did was use hyper-advanced mathematics accessible to only a select few. And this is the big difference between this and the trading and technical analysis that so many snake oil salesmen are peddling out there. In trading, instead of using maths that's only within the reach of the brightest minds, well, they use formulas like momentum or the relative strength index. We're talking formulas simpler than the rule of three. And if the trader is really sophisticated, they might even calculate a moving average. That is, the average we've all known our whole lives, but calculated many times for different points in time. But of course, that's for those who use maths. There are traders who simply don't draw triangles or horizontal lines like the ones you see on the screen. And that's it. Why these triangles and not others? Well, just because they come up a lot. Now, despite this, technical analysis, that is, trading based on observing charts, is used extensively. According to most surveys and analyses, at least 1 in 3 individual investors considers technical analysis to be important in the short term. But despite this, the most cited scientific study on the subject paints a very negative picture of this technique.
Our main point is simple. Trading is hazardous to your wealth. Why then do investors trade so often? People are overconfident, and overconfidence leads to too much trading.
According to an analysis of more than 65,000 households, the investors who trade the most, those who buy and sell the most, achieved returns of around 11.5%, which, mind you, isn't bad at all, but during that same period, those who simply bought some stocks or funds and forgot about them achieved a return of 18%. And it doesn't matter what time period we repeat this study, whether the market is bullish, bearish, or stagnant, the conclusions are always the same. Trading performs far worse than the simplest, most mindless strategy of all, which is to invest in a fund and forget about it. But what's really interesting is why they do so poorly. In this chart, you can see the returns of various investors based on how much they trade. The bars on the left represent individual investors who buy and hold for years. And moving to the right, we see investors who trade more and more, to the point of changing 20% of their portfolio every month. Two things stand out. First, gross profits are practically the same for everyone. So far, trading isn't that magic formula for getting rich, but it doesn't hurt either. The problem arises when we look at net returns. That is, returns that account for fees. Since traders make a huge number of trades, and each trade has an associated cost, they end up paying much more to achieve the same gross return. And so, their net return, the real one, drops by almost half. And yes, I know what many of you are thinking. Hey, Josh, despite everything, traders are still in the black. And yes, that's true, but it's not surprising either. The stock market, in the long run, always goes up, at least historically. You'd have to do a really, really bad job to lose money as long as you diversify sensibly. And since trading is basically random, half the time you buy high, the other half low, and you more or less end up breaking even. The difference is that you do it with much more volatility and risk because, of course, in investing, we don't just look at a percentage return, but at the risk-adjusted return. If there are two equally profitable investments, the less volatile one is better. Why? Well, imagine, say that you're in a car accident and you need to buy a new car to get to work. If your portfolio is very volatile and things happen to be in the red, you might have to sell at a loss, losing the savings and profits you've been investing for years. So volatility is bad business. In any case, with everything we've just told you, we're analyzing exclusively what happens with moderate traders who buy and sell a lot of stocks, but nothing crazy. Even so, there are people selling courses that go much further, encouraging individual investors to do 3 things that would directly ruin them. Pay attention to the warning from the European Securities and Markets Authority regarding one of trading's favorite instruments, CFDs.
CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. Between 74% and 89% of retail investors lose money when trading CFDs.
Why do beginners lose so much money when they start trading? Keep in mind, we're talking about more than 1,500 euros per individual investor. Well, there are several reasons, but let's go through them one by one. The first reason is leverage, basically going into debt to invest. If you go into debt and the investment pays off, great. But if it goes wrong, then you could be in debt for life or lose your money extremely quickly due to a margin call. Most reputable brokers don't let retail clients take on too much debt. To give you an idea, getting a loan for 10% of your own capital is already quite a lot. However, there are others who will lend you double, 10 times, or even 100 times more. In some cases, they even disguise the debt under the guise of investing with other people's money. What they don't tell you is that you're the one who ends up covering all the losses. Traders often use short selling, that is, betting that a stock will fall. The problem is that when you buy a stock for 100 euros, the most you can lose is those 100 euros, and that's already extremely rare. But when you short a stock, when you bet on a decline, there's no limit to your losses because the price can rise indefinitely. You might invest 100 euros and end up owing 1,000, 10,000, or 100,000. And if you're leveraged, well, that debt multiplies as well. And as if all that weren't enough, these CFD trading platforms also encourage you to trade with highly complex instruments. We're no longer talking about stocks or bonds, which follow simple rules, like if the company is doing well, so are its shares. We're talking about products so complex that they're basically designed so that small investors hand their money over to the big players, who are the only ones who actually understand them. What's more, there's one case where this difference between retail investors and the whales is perfectly illustrated. Taiwan. In the 1990s, gambling was banned in Taiwan. No roulette, slot machines, or sports betting. Do you really think people just stopped gambling? Obviously not. Some gathered in underground venues, and others started trading. The numbers are crazy. Taiwanese people ended up trading up to 3 times as much as Americans, and you can already see the result on your screen. Individual investors lost the equivalent of 2% of Taiwan's GDP due to these bets. What's more, this study found that when traders get lucky, they become overconfident, make more aggressive bets, and end up losing more money. I mean, you tell me. The fact that people start trading when the government bans gambling doesn't exactly paint trading in a great light. Now, professional traders, or those who sell courses who sometimes aren't even real traders, might say, yes, most people lose money, but that's because they treat it like a gamble, because they let their emotions get the better of them, or because they haven't taken their course where the secret technique is revealed. If they did it right, they would make money. Well, do you remember Simons, the richest mathematician in history? Most people who try to imitate his method fail, but that doesn't mean his fund's investment philosophy is wrong. It means most people aren't smart enough to put it into practice. On top of that, we have to acknowledge one thing. There are indeed patterns in the markets that repeat more often than usual, such as the famous shoulder, head, shoulder. And this isn't a PDF pulled from some course, it's a scientific article published by a prestigious finance publisher and cited thousands of times. The article itself states that a major problem with trading, and specifically with technical analysis, is subjectivity. Every trader sees the patterns they want to see, and there is no theoretical reason to choose some over others. Nevertheless, there are some specific patterns that can be informative. So, does this mean that technical analysis isn't a scam? That it can make sense if done right? Well, no. Let's not jump to conclusions. What we just told you is true, but there are some nuances that make trading completely useless. For starters, it's one thing for these patterns to exist, and quite another for you to know which one is going to occur before it happens. And here, many advocates of trading have the same problem. They're armchair experts. In other words, there are many different patterns that start the same way, but while you're trading, it's impossible to know which one will actually play out.
Persistence tests show that even with the more powerful FDR technique, an investor would never have been able to select Exani the future best performing rules.
But even if predicting patterns were possible, which, by the way, it isn't, it still wouldn't be enough to make money. The probability of getting it right remains extremely low. Better than chance, but low. And I know what many of you are thinking. As long as it's better than chance, what does it matter if it's low? It's still a positive probability, and yes, in the long run, you can make money. But we're not taking one thing into account here. Trading isn't free. Every trade has its fees, and these fees will always be much higher than the money you could make with this method. But as if all that weren't enough, there's still one final nail in the coffin. In the first half of the 20th century, only between 25 and 50% of traders outperformed the market, and virtually no one underperformed it. Note, this was before commissions were paid. However, since then, the tables have turned 180 degrees. Today, there are practically no traders who consistently outperform the market, but there are about 25% who do much worse. So what has changed? Well, the market has become much more sophisticated. On the one hand, financial mathematics has come a long way. And while it's true that the best funds like Medallion keep their secrets to themselves, some of that knowledge has trickled down to the rest of the world. On the other hand, many decisions are made using algorithms, so large funds aren't driven so much by emotions as by numbers. There are also things like high-frequency trading, which, even though it has trading in the name, actually has nothing to do with it. It involves people buying and selling instantly, in less than a millisecond. But here, they aren't trying to predict the price. Rather, they're correcting inefficiencies, such as when the same product has a slightly different price in two different markets. Conclusion, if you trade, you're probably going to lose money. And the more you trade, the more money you'll lose. Although maths can be used to make money in the stock market, there's no theoretical basis for this, and the small gains aren't enough to offset the commissions. With that said, what do you think about trading? Do you invest regularly? Have you ever traded? What were your results? Leave your thoughts in the comments and let's start a discussion. And if you want to understand what's really happening in the markets and learn how to manage your money with more confidence, unlike the traders, join the Visual Factory Club. It's completely free and the link is in the description. But for now, all the best. I'll see you soon.